So, John Mickelson, I'll let him introduce himself, and we'll turn the time over to him. So, round of applause.
So, I really want to say that I can talk about anything. So, we're going to talk about the Australian Open and the Super Bowl. Yeah. Anyway, I'm a wealth manager, financial planning, estate planning. That's kind of my area of specialty, I guess. I've been doing this for 27 years, if you believe that. It went forever. And I have a local firm here in Logan. We also have offices in Salt Lake and in Sacramento, California. So, in fact, you can kind of see our team. So there's the team. So Brad Harsh, he's our outlier. He's our investment officer, and he's in Sacramento. So anyway, but just so you kind of have a little background on me. I attended Utah State for 2 years, and I attended BYU for 2 years. So pretty much nobody likes me. So both good schools. I had a great time here. I had a great time there. I ended up finishing in international finance with a minor in marketing and accounting and Spanish. And so that's kind of my educational side. And by the way, I'm going to give you a little introduction, and then this is going to be a discussion. It's not very fun for me to just talk this morning. But I do want you to have a little bit of kind of where I came from. So after graduating, I started working with a firm just doing a kind of estate planning. They were an insurance-based company. And after a few years, I kind of didn't fit that world very well because I was doing more on the investment side and less on the insurance side, which is part of the estate planning. So after that, I just went independent from any company. And basically what that means is some companies are captive, meaning that you work for the company. So for example, the retirement plan here is TIAA-CREF and Fidelity for all the professors. Those representatives work for that company. So they're going to represent, what's best for the company itself. I don't work for any company. I work for you. I work for the individual. And so I like that model better. We're compensated on the idea that it's a percentage of assets. So if my clients do better, me too. If they do worse, me too. So we can talk more about that as we go. So undergrad was in international finance. I was sure I was going to go work for a multinational and go live all over the world. And instead, I moved back to Cache Valley and worked with my dad doing some real estate development. And then about half my time doing the financial planning side. So after that, I probably worked here with my dad, which honestly, the book side of things, Utah State, amazing. BYU, amazing. I still miss the business buildings in both schools. And then I kind of came back, and my dad was, he built the Spectrum. He built both football and basketball. He built the fine arts building. So, I mean, he was big commercial jobs and built churches and stuff like that. Anyway, so when we came back, he was honestly the best education outside of like the book learning. He just had a knack for knowing when to step on the gas and when to step on the brakes. He knew how to relate to people, big part of it. So that was kind of just my, and then, so I worked with the development company and the investment side for about 4 or 5 years, 6 years. And at that point, I started working with a group called Strategic Coach. Now, Strategic Coach is a coaching forum where they have a coach up front, and then they have all of us, which are all entrepreneurs from different fields. So it's not just financial planning. There was one guy that did plumbing and heating. There was another guy in a big firm, like he had 20 or something locations. We had one that just did window dressings in big department stores in New York City. That was their job. Anyway, so there's all kinds of variety, but you have all these entrepreneurs, and you have to be in command of your own business. You can't go work for somebody else. That's not what it's designed to do. So I went to Strategic Coach, and there are usually anywhere from 20 to 30 people in the room, and you have someone that introduces an idea. And it can be anything from human resource management, employees, marketing, what investment tools work well, which podcasts are really innovative and ideas that are creative and cool. I mean, it was all kinds of things. And the way they formatted the group was they had 50 minutes and a 10-minute break. And then you went on to another subject, 50 minutes, 10-minute break. Perfect setting, I thought. I like that idea. Everything was kind of compartmentalized. So during the day, you'd probably come up with 8 to 10 different really cool concepts. And of those, you'd probably use 1 or 2 during the quarter. And we met every 90 days. So every 90 days, I was flying to Los Angeles to meet with this group. That was very innovative for me. In fact, when we started, there was a friend of mine in Montana and a friend down in Utah County. And we said, you know, we got their materials. Let's just do our own study group. We don't need to be part of that group. It's expensive. And so we did. And it was good. It was really good. And then one of the groups said, you know what? I'm going to join Strategic Coach. And so he joined. And we said, go ahead, waste your money. We have all the stuff. We can do it ourselves. He said, look, all I know is people join that group, and within a year or 2, they double their money, double their income. And I don't know why, but it works. So he joined. We said, go be stupid. That's fine. And within 6 or 7 months, he doubled his income, and we all do it. So that was really a big part of my education, because it helped me kind of come up with systems and ideas that I probably wouldn't have come up on my own. Because a lot of times when you're an entrepreneur, there's nobody to go ask questions to. I mean, you're kind of out there on your own, and you're competing with the people that are like you. So it's not like you can go to them and ask questions. I mean, that's who you're competing with. So this was a great environment. Now, one of the first things they did, and by the way, at this time, I started working on my master's degree. So my master's degree is from just outside of Philadelphia, Bryn Mawr, Pennsylvania, the American College. And it is focused just on financial planning, just on wealth management. So that's where my master's degree is. So back to Strategic Coach. So one of the first things they do is they say, okay, everybody has their unique ability, something you're hardwired with, that's not like anybody else, and it's your talent. And so they make the point of saying, yeah, you can go work on your weaknesses, but no one cares about your weaknesses. If their weaknesses become mediocre, nobody cares. They want your strengths. So work to your strengths. Your whole business should be built around your unique ability, whatever that is. So they had me profile 15 of my own clients. Why did you decide to work with me? What is it that you needed from me, to try to identify what it was that they wanted? And we did. I mean, it was really interesting. So I go back. There's like 20 other entrepreneurs analyzing my business. And they said, okay, you're doing financial planning, you're doing real estate with your family. If your income was no object, you didn't have to worry about your income, what would you spend your time on? I said, oh, financial planning and estate planning, that's way more interesting. And they said, well, then that's what you should do. This was 2007. Why is that important? I got out of real estate in 2007. Now, I could have written a book, all the signs I saw before the crash came. I could have made them, the reality is I didn't know anything. Now, my family didn't know that, and I didn't want them to know that. I want them to think I'm a genius. How did you know? Anyway, so I did get out at that point. Now, it was still hard in financial planning, because it was a big, huge drop. I mean, it was scary. Would people still need what I was doing? I mean, that's one of the fears of any entrepreneur. What if things innovate and change? So one of the stories I'll tell you about that, because right now, even in financial planning, they say, oh, AI is going to replace financial planning. Now, I kind of think there's some truth to that, but there's also a big fallacy there. And the reason why is because what I do requires a certain element of creativity. And so anything that, even in my office, I tell my team, anything that's a repetitive problem, that is because we don't have a system. So if you see the same thing coming up over and over, the same problems, you've got to figure out a way to make a system so it doesn't happen again. Things that are come up randomly that are unusual, I tell my team, use your God-given talent and solve the problem. Don't call me, fix it. Okay, so we basically systematize everything that's repetitive and humanize everything else. Now, the reason I think that's important, especially in what I do, is because no one's going to know when a company suddenly has a scandal and it causes a stock price to drop. You can't systematize that. These crises that happen, even look at the last 4 or 5 crashes. Look at going from 2000. Okay, in 2000, you remember what the crash was? Do you guys know?
Well, they were born.
3 negative years in a row. It was the dot-com bubble. Yeah, you guys probably don't even remember because it was that long ago. Just from study, I wondered if you'd know that. But the reason why that one's significant, it's the longest downturn. Not the deepest, but the longest downturn we've had. 3 negative years in a row. The only time that's happened besides 2000, 2001, 2002, the Great Depression. So downturns don't last all that long, honestly. And the upswings, and I'll show you a graphic on this later, but So the reason I say that is because if you say, okay, there's always a human element or a creative element, and there's always at least some systematic approach, that's AI. So here's my story. I stole this from somebody else. So he said, when I was in high school, and he's older than me, by the way, so this will make more sense because well, I am, but not as old as him. He said, when I was in high school, I got my first bet. Now, it was a chill bet, but it was a bet. And the reason why it was important is because it had an 8-track player. In fact, I'm jumping ahead. Let me back up. He said the first album he ever bought, greatest album he ever bought, he loved it. And it was the Pink Floyd, The Wall. Okay, you guys all know the Pink Floyd. So every track was awesome. He bought it on vinyl, record player, you know, played it to death. Then he got his first bet. Now, the reason why that's important, 8-track player. Now you went from having a record player in a room to, I can take that music with me in a car, go from place to place. You know, that's nothing to us, right? This is so different now. But for then, it was huge. Then came out with the Walkman, right? Cassette player. Put it on your hip, you can go anywhere you want. And the technology improved. Then CD player came out. Player, so much different. And then streaming came out. MP3 player, that little thing that had 150 songs on it, teeny tiny little. And then streaming, you know. So each of those periods, what was the first thing he bought? Pink Floyd, right? As soon as it went to a cassette, Pink Floyd. As soon as it went to a CD, Pink Floyd. Now he bought that, and every time the technology improved and it improved and it improved. By the time he got done, what was the one common element in the whole story? Pink Floyd. The creative element was the human element. So as long as there's a human element involved in my business, there will always be a place for that. So I tell you that because as you guys evaluate careers, you need to be looking at what is my God-given talent. Don't do what you're passionate about, do what you're good at. If you're good at it, I promise you'll love it. At some point, you're going to create value for other people, and it's really rewarding. So let me tell you one more, and then I'll start opening up some discussion. So when people say, how do you do what you do? I'll show you that in a minute. But the more important question, have you ever heard of Simon Sinek? Why? Answer the question why. Why do you do what you do? Here's my why. So yesterday, one of my best friends, now I have 4 friends from high school. I've known this one friend, Brad. I've known him since preschool. So his mom passed away actually yesterday. Now, when her husband passed away, he kind of passed away really quick. Like, was kind of unexpected. And I remember her coming into my office, big box full of paper. And she said, John, I'm worried. I don't know if I'm okay. I never did the money part of the things. And I'm worried I don't know if I'm going to survive. And so, you know, this is someone that's like my mom. I mean, I lived in that house. And so I said, okay, Karen, come back tomorrow. I'll go through this tonight, come back tomorrow. So I spent kind of the later part of the day and into the evening, organized it all, put it on on her webpage so she could see where she stood. She walks in the next day, she sits down, and before I even show her one thing, I said, you're fine. You don't have anything to worry about. And you could just see the pressure lift. Now, that to me, if I could do that all day, every day, that's all I would do. You wouldn't even have to pay me. So that's kind of why I do what I do. I love what I do. So for me, it's solving problems. Okay, so that's just a little bit of background. I'll show you some ways I approach, like the first time I meet with somebody. Questions before that. And what I'm hoping is I haven't killed the momentum in the room by just talking and talking. So, okay, yes.
You said the talent. What was yours? What did you?
Mine was taking complex ideas and simplifying them in a way that people could understand. The second thing they said is you garner trust really quickly. Now, that can be a two-edged sword. Because even though people say, oh, I can garner trust, I've had partners, they can bring people in the door, they can't keep them. Now, let me tell you another thing about my business. When I came into it, I thought, oh, it's all about statistics, probabilities. I mean, it's a probability study. That's what I do. How do I invest highest return to the lowest risk? If people can see that logically with the statistics, of course they're going to do it. That is not why people work with you. People work with you initially because they like you. And there is no getting around it. Look at the presidential elections. From the time video was introduced, your ability to present yourself is a huge factor. It wasn't talent, it was your ability to present yourself. Likability. So don't underestimate that. Networking amongst yourselves will be a big deal later. You know, so take advantage of the human element of it. But the other thing I was going to tell you, what was it? The likability, probability versus likability. So people will generally, they will start working with me because they trust me and they like me. But they don't stay with you unless you're good at what you do. And those are two different things. So I tell everybody, you know, you have to have the human, you know, the interaction, people skills, but you also need the technology side or the intellectual or analytical. And that sometimes is kind of hard. Usually we're more talented on one side than the other. And that's one of the things that makes my business pretty challenging. It's like any small business. Only 10% survive the first 3 years. That's hard. Think about that. The group that I started with, there's only 20 of us, one other guy that still does it out of all of us. So now that's over a long period. But my point with that is you have to really evaluate, am I willing to work? Because one thing is I go down to Salt Lake every week with those 20 guys. And I kind of, right here for my next thing. Sorry, I'm going to talk some more, but I'm going to start with a story and then I'll come back to that idea. So 25 years ago, I was fairly new in the business. We went to the American Airlines Training Center, which is in Dallas, Texas, and did a financial planning conference, so to speak, for new guys. And this guy comes into the room. His name's Randy Marshall. Now think about it. I don't know how many conferences I've been to, how many classes I've sat through. This is the one I remember by far the most. And this was when I was like just starting out. So you can imagine, I mean, this was a pretty significant thing for me. So Randy Marshall comes into the room. There's 20 of us in there, 25 of us, something like that. And he says, okay, we're going to talk about goals and desires. And we're like, oh, how many discussions are we going to have on goals? You know, because we thought we would be beat to death. And so he said, no, let me start with this. He said, how many of you guys in here think a great marriage is a great goal? And of course, everybody raises their hand. And he said, you guys, you're so dumb. That's a terrible goal. And we're like, where's he going with this? And finally he said, okay, you got to understand my definition of what a goal and a desire is. A goal is that which I and I alone control. A desire is what I hope will happen and I have some control, but I don't have full control. He said, so, and he was, by the way, he's a pastor of another faith and a big sports guy. So he said, I work for my goals, I pray for my desires. And the point he was making is if my goals are focused in the right places, the chances of my desires happening ought to go way up. And so he said, back to the marriage thing. He said, if your biggest objective is a great marriage.
Okay, I found this on the web for set-in. Check it out.
Wow. I don't know that I said anything to Siri. Anyway, so he said, if you're focused on a goal of marriage, that's your goal. And you have one person that's willing to work their guts out, do anything that's possible to make that good, make it happen. The other one's a liar and a cheat. That's going to fail. What happens to the person who said, my biggest goal is marriage? Devastated. Okay, what should the goal be? Be a great father, be a great husband, right? I have control over that. So if that's the case and the marriage fails, and I can say, hey, I know I was a good spouse, a good partner. That's a lot easier to live with than if you're just devastated by the fact that everything failed. Now you can translate that. That was his point, and it was a good point because it forced me to think, okay, like I'm going to make this much this year. Well, I don't know who says yes and no to me. I can't control that. What I can control, am I the most educated? Am I the most prepared? Am I on time? Do I say please and thank you? I mean, that sounds simple, but it's true. Big deal. And do I do exactly what I say I'll do? If those things are really the things that make someone very good and very desirable in what they do. Okay, revenue, I don't know. I've never been one to say I'm going to make this much this year. Now I hope that they will go a certain way, but if I focus on the things I control, it makes a big difference. So anyway, that's just so you kind of have a little bit. That's all kind of the education stuff. What other any other questions before I kind of go into how I do what I do? Okay. By the way, when do I have to end?
2:30-ish.
Okay. Okay. So
We have the class a little bit longer, but I'm sure there'll be questions afterwards. So kind of.
yeah, this is where I want you guys to be asking stuff as we go. Okay, so don't be shy. So when someone comes in and sits down with me, the first thing I want to know is what makes them tick, because everybody in here has a different financial fingerprint. Meaning that if I said, what does risk mean? You're pretty much all going to come up with something different. So it's important for me to get kind of a grasp of what the person in front of me wants. And I hope that makes us different from a lot of other firms. A lot of other firms, it's, okay, how do I put them into a certain box? How do I quantify what they are and then push them into that one spot? We try hard to be, we're a smaller group, as you saw up on that screen. We're not big. And I don't want to manage people. I want to meet with people. So that's one of our intents, is to try to have the right clientele.
Hey, you got a question up here.
Yes.
So you just said that you want to kind of learn what people want. What is it that you want people to want? Or what is desirable for someone?
Okay, you're going right where I want to go. Okay, so here's the first thing I do when I meet with someone. Okay, tell me your name.
Jason.
Jason, we're sitting down. Let's say that it's 3 years from today, 2026, beautiful January day. And you say to me, that was the greatest 3 years. I don't know how life could have been a whole lot better. What would make you say that? Now, that's the question I ask almost, and I repeat that. People have heard me say that over and over. But what I want to know is, what is it that they really are after? So often, I'll call that the relationship question. So I'll have people say, lower debt. I have people say, I want more time with family. I mean, you can imagine all the different things people will say, and it depends on what stage of life they're in and what they've done so far. But it still gives me a good sense of who they are and what they really, really are after. You know, you get all kinds of things. Is my retirement on track? That's one that's directly related to what I'm doing, right? How do I make my money a blessing and not a curse when my kids get it? That's a big one. Okay, so those are some of the things that I get when I ask that relationship question. So then that's nice, that's nice theory. How do we put that into practical measure or practical application? So everybody, whether you have 10,000 or 10 million, everybody should be organizing their money into 3 buckets. Now we do this on a whiteboard first, but we eventually will put this on like a client website. Every client we have has their separate website. So you have a now bucket, you have a soon bucket, and you have a later bucket. Okay, the now bucket is the bank. Okay, what's the benefit to the bank? Liquid, you can get to it quick. What's the downside? You earn relatively nothing, right? So, but it's the most important of all the buckets, because if Christmas rolls around, car breaks down, go on vacation, that's where the money's going to come from. So income goes in, expenses go out, and then in here you need this little bit of float in here. This is your emergency money. Okay, and so people will always say, okay, well, how much do I keep there? Now, by the way, this is not all of your safe money. This is just your money that we can say, I can walk in and walk out today with that money. So I usually tell them, look at your come and go of the month. How much up and down do you see? And then double or triple it. So someone says, hey, I want to have $15,000 sitting in there at any given time. So what we say is we want that number to be kind of your driver, your target. We always want to have 15. It just makes me feel good. And in theory, you think, oh, it's just going to sit there and make me feel good. Nah, it'll get disrupted. Something will happen. And what you need to do is say, I need a trigger point. If it gets too low or too high, I should take action. If it goes too low, say it goes to 7,000. They're going to call me and say, John, replenish. In here, maybe we put in here safe money. This is your reserve. And this is muni bonds. It's floating rate funds. Could be CDs, not right now. Anyway, stable stuff. It's not dramatic. Hopefully we can earn, 4 to 6% here. But it's stable. If the market's like it is right now, and it's down 20 or 30%, that better be very stable money. So if I get too low, pull the money over and replenish. If it goes from 50, say you get $30,000 in there. You say, hey, I have a little extra money. What do I do with that? Go back to here. What are we trying to do? What are we trying to accomplish? And so what we're trying to do is make sure that we can accommodate a lot of people, but still be systematic enough, or well, let me back up. Accommodate a lot of people, but still be unique enough to say we want to tailor it to each person. So in the soon bucket, what other objectives would be kind of intermediate things that people worry about? You think of anything that, why would they save or invest for intermediate?
Down payments.
Yep. All right. Maybe I'm going to upgrade to a bigger home. Or I need a car in a couple of years. Or I need education funds for kids or grandkids. Lots of intermediate things, right? And then later bucket's going to be retirement accounts, real estate, business interests, partnerships. This is the goose that's going to lay the golden eggs forever. So realize you have a lot of competing forces with whatever money you have. And it does boil back to budget. You know, how much money do I have beyond the needs I have for right now and the normal lifestyle I have? Where do I want that money to go? So one of my jobs is try to to make people intentional about what they've got. So for example, if I go to someone and say, all right, what did you do with your last raise? About 9 out of 10 will say, I don't know. You know, I just assume it into their lifestyle. What people do a lot. Instead, if you can be intentional and say, okay, when I get the raise, what do you want it to do for you? Maybe you do want to be able to do more now. You know, I want to take trips and I want to go out to eat more, or whatever. But other people would say, no, when I get that money, I want it to be for some of those other things that we talked about. Okay, so that's kind of the how. So I've told you the why and the how. Questions on any of that? The other thing is, remember that risk is a factor in all of it. There is no way getting around. People say, oh, we make these big returns and there's just no risk. My very first manager said, John, all these insurance and investment companies all want to make it look larger than life. They'll market it and make it sound all these fancy names. He said, don't ever forget, there's only 100 pennies in that dollar. It's got to come from somewhere. So it's always good to take a critical eye. And one of my jobs, I'm the navigator. My client is the captain. My job is to say there are 4 ways to get to the same place. Here's all the bad stuff. Here's why you do it anyway. And then pick a direction. So that's a little bit more on the how side. Okay, questions? Anything you're wondering about that? Yes.
So like, where would you invest money for like the soon bucket?
For the soon bucket?
Money go?
Well, okay, so one of the questions you'd have is the time frame on it has a lot to do with where we go and conditions of the market. So think of where we are now. What's just happened in the last couple of years? What's going on with the economy? Yeah, it's down, right? We're down anywhere from what, 15 to 25% in the stock markets, depending on if you look at the S&P or the NASDAQ. Why is it down? That's a tough question. You can answer that. That's impressive. Okay, let me show you a couple of things. Let's see if it'll come up again. Okay, so what I want to show you. Okay, is that up there? Good. Okay, this graphic is every up and down market since 1942. So the first thing that should grab your eye, what do you notice when you look at that graph? Yellows are the down markets, the bear markets. Blues are the up markets or the bull markets. What grabs your eye first?
Blue.
The blues are long, right? Now, during those blue periods, there's still a lot of choppiness. There's still a lot where people say, oh my gosh, it's going down, you know. But the point is there's this long stretch of years where the market's going up. The down years, they don't last that long usually. Okay, so with where we are now, let me show you 2 things and then I'll come back to your question. Look at the last decade or so. Okay, so the first one I'm going to point out is this one right here. Okay, that is the one I mentioned, the dot-com bubble, 2000, 2001, 2002. That is the longest downturn, not the deepest, the longest. 2.5 years, almost 3 years, negative returns. Okay, so you see it went down 36%. It was down for 1.5 years. You have this little blip, but that didn't really count for a whole lot to me. So it's about like I said, 2.5 to 3 years. And then followed by 5 years of growth, 100% return, 15% a year. But then this one, this is the one everybody refers back to. What is that? Yeah, 2008. Yeah, the big scandals and crashes, right? It's a pretty interesting period. But deepest, look at that. Now, it lasted for 1 year and 3 months, if you take the little blip out. But that means, you know, you were down 50, almost 52%. I think if you had $100,000, you get your statement that says less than 50. That is a hard pill to swallow. Okay, but that's what happened in 2008. Now, look what followed. 11 years of growth. There's 400% return, 15.8% per year. Pretty nice stretch. So the other thing I'd point out on this one, inevitably, when we have a downturn in the market, I will have a certain number of people call and say, man, should we get out until it gets better? And my answer will almost always be, no, go in. And what you want to do down in here with money that's already been in, weed the garden. Go in. Is there stuff that went down further than it should have? It didn't do what it was supposed to in the down market. Pull it out, put it better in its place. New money, it's buying season. Right now, the markets are down so far. Everything's on sale. It's cheap. There's so much more pressure to go up than down right now. Now, it may not happen for another 3, 6, 9 months. But remember, the length of the downturns, like a year and a half is kind of normal. Unless there's some major crisis like the 08, there's a lot more fundamental problems there. Now, let me finish this. Okay, so then we get to here. You know what that little blip is? That's COVID. Why was it so short? Does anyone know? Yeah. Yeah, you can throw money can cover up a lot of problems. So they pumped $3 trillion with a T into the system. Unprecedented amount of money. Huge. And that money went to individuals and companies. You know how much is still in cash? Just under half. Why? You know, the government said, well, they got all this cash. Why aren't they using the cash to stimulate the economy? Part of it is, yeah, porting. Scared. There's another reason that's even bigger. The ports, right? So what little stuff could get through the port, everybody's got cash. What does that do to the price? Inflation. And then you couple that with no production of U.S. oil and gas, but for better or worse, inflation. So that's what we're dealing with. So we had this period where money covered up that period right there. Everybody had money, spending it on stuff to stay home, all that kind of thing. And then this is a little old now, but we've been down a little over a year. And again, we already talked about it's down that far. Now, back to your question. So now we looked at it and say, okay, how do we know, what do we do for short, medium, and long? Well, remember that as you mix assets together, so there's major asset classes, cash, stocks, owning companies, bonds, you're like the bank lending money to somebody. And then there's alternatives. Does anyone know what an alternative is? It's something that doesn't move in lockstep with either stocks or bonds. It doesn't move in the same way. So real estate could be, but real estate kind of moves in lockstep with. So things like commodities or precious metals. Arguably, they say, you know, Bitcoin and digital currency, that's kind of followed the market as well. But the idea is by having these different classes, one's going up and one's going down, they kind of offset each other. But as a group, hopefully they're all growing over time like this graphic shows. Okay, so how does that relate to risk? Well, normally you'd say, okay, here's somebody's pie, everything they own. And they say, okay, we got a little bit of cash. Now, the rest of it, if we say, hey, let's put 70% into stock and 30% into bond, that's kind of a very common mix in portfolio. Now, this is actually spread out over literally hundreds and hundreds of companies. So let me show you an example of that. Okay, so let's go with this one. Here's a 70-30 mix. Now, some of these I'm going to invest in companies that, for example, on the stock side, you own companies. Okay, there's 2 different ways you can invest in companies, generally speaking. There's companies that take, when they earn money, what do? Reinvest, right? Everything plows back into the company. Tesla, probably a bad example right now. They're way down. But plow everything back in. Those are called growth companies. They're expanding. Okay, then there are companies that are not expanding. For example, Coca-Cola. Where are they going to expand? They're already everywhere. So when they make money, what do? Dividends. So dividend paying companies are usually more established, and that's why in a downturn they're seen as more stable because they're just cash flow. If things get bad, they just turn down the cash flow. Whereas growth companies, they have to stop building stuff. That's challenging. So you see a bigger hit when the markets are turning down on growth companies. But the point being, we can look at these portfolios. See, here's one that's growth driven. Okay, look, here's a great example of ups and downs. So, oh, by the way, let me show you this first. Okay, this shows, what are we doing on time? Okay. This shows, here's US stocks, 57%, internationals is 12, and then bonds is about 30, and there's a teeny bit of cash in there. So that's one of the portfolios we manage. Here's where, remember, here's the value and the growth. Growth, plow back in the money. Value, pay dividends. Blend is kind of a combination of the two. Then you have the size of the companies. So what this is showing is of this stock portion right there, how am I weighted in these different areas? How much weighting do I have? Now, notice this. This portfolio holds 5,000 companies. If one of them goes bankrupt, I hope my clients never notice. There's lots of diversity. Now, the other thing we're doing with this one is we're saying of this stock portion, we're going first to exchange traded funds. What's an exchange traded fund? Anybody? It mirrors a market. So you can have exchange traded funds in the NASDAQ, the S&P 500. If the S&P 500 says these are our 500 companies, guess what the exchange traded fund owns? Exactly the same 500. You're not trying to beat the market. You're trying to be the market. Now, that's the distinction between an exchange traded fund and a mutual fund. A mutual fund has a manager that's trying to beat the market, trying to outperform it. So people always say, well, which one's better? Well, it depends. If the markets are really high, exchange traded funds to me make the most sense. If you're in a down market and you say, hey, there's opportunity everywhere, you have a good manager. They can find buys that will outperform. Now, what we've done in this one is we said, let's just take the exchange traded funds because they're cheaper, by the way. The cost of an exchange traded fund is about 0.2%. That's pretty low. It can be lower, it can be a little higher. And a mutual fund, it's usually about 0.5% higher, about 0.7%. So more expensive. So in other words, if I'm in a mutual fund, it better earn at least 0.5% above the market or better to justify that manager's existence. Okay, any questions on that? Okay, so what we've done in this one is we said, hey, stay with exchange traded funds on the stocks, which we said we're going to go 70%. Now, of the 70% in stocks, what if we take 10 to 20% and we look at individual companies that we think have huge potential? So everything you see right here, and these change all the time, but everything you see where it says ETF, exchange traded fund, that's trying to mirror the market. You're in thousands of companies. Look at the percentage of the money in there. 8%, 7%, 7%, on down here to 3. Then, oh, individual stocks, and look who they are. Now, these are the large companies. We have like ones that look at just small companies, and you probably wouldn't recognize hardly any of the names. You'll recognize all of these, well, most of them. But there's Adobe, Google, Amazon, Apple, Charter, Lumina, Microsoft, NVIDIA, and Tesla. Look at Tesla. Ouch. Look at those one-year returns. Now, why are we putting them in there? Because they're dirt cheap. I mean, look at the one-year returns here. And then up here, you see here's 3 years. Still some negatives in there. By the time you get to 5, you start seeing bigger returns. But the point being, when we blend all these, you push them all into one big mix. What does that look like? And what that looks like is, in terms of like return, there's a lot of ways to look at this. But look at this. Okay, so ouch. 1 year return, 22, almost 23% down. 3-year average. Now, by the way, we create a benchmark that parallels the same proportions. So much in small companies, so much in large, so much in bonds. So we want an apples, because one of the games that I see played in my industry Someone will say, oh, here's your portfolio, and then they measure it against some crappy benchmark. Look how good you're doing. That's totally misleading. So you've got to have something that's apples to apples, as close as it can be. So you can see right here. See, there's the portfolio, and then we've tried to blend the benchmark. It's not perfect, they're off a little bit, but they're close. So we're trying to make it as close as we can. And that way, when we go back here and look at the performance, we can say, okay, here's our portfolio return, and here's the benchmark. Then we say, hey, we were worse than the benchmark over the last 3 months by almost 4%. We were worse than the benchmark over the 1 year by 7%, meaning we took more risk, higher highs, lower lows. But look at the 5 year. We're at 9. Even after losing 22%, we average 9 over 5 years. And that's 3% better than the benchmark. 13 over 10 years. Now, if you can earn 5% per year for 10 years compounded ahead of the market, add it up, it's huge. That's big. If we can accomplish that, that's enormous. And maybe we will, maybe we won't. These are hypotheticals. So that's just to give you a sense of, you know, the nuts and bolts side. Remember how I said people will work with you because they like you? You need to be good at what you do, or it's just like a revolving door. So okay, that's some of the statistics behind how do we measure the risk, because right now, as we look at risk, to your original question, we're looking at it and saying, the markets are down so far here. Is there that much risk going down versus the benefit going up? Right now, I would argue a lot more potential up than there is possibility of it down. It probably will go down a little bit. I think it's going to be a choppy quarter. Earnings reports are going to be bad. After that, I bet you we're at a low point, and I'll bet it will start to improve a little bit. And who knows? I mean, okay, I got to read you one of my favorite quotes because it's funny. Okay, give me just a second here.
Just to summarize, so you're saying you're putting more of your clients' money in the soon bucket in stocks now because it's lower.
Normally, we would say
Put it
that's too risky for the middle bucket.
For the middle bucket.
We would go 60-40, with 60% stock, 40% bond. That would be a 5 on a scale of 1 to 10. Zero risk down here. You want no risk in this bucket because that's your safety, you know, if things cycle. Now, in this one, if it's 60-40, it means you got 40% that's pretty stable stuff. That's the reserve piece that I was talking about. Right now, I'm saying go a little more on the stock side because I don't think there's that much risk on the down versus the up. And again, that's where you have to realize that's the human nature part that you cannot computerize. You can't look at that and say, okay, how much risk is there going to be? There's a lot of variability. So that answered the question.
Yeah, perfect.
So, okay, here's my stock forecaster quote. Okay, and you'll like after I'll tell you who it was. You'll figure it out. We have long felt that the only value of stock forecasters is to make fortune tellers look good. Even now, Charlie Munger and I continue to believe that short-term market forecasts are poison and should be kept locked up in a safe place, away from children and also away from grown-ups who behave in the market like children. So that's a Warren Buffett quote. Anyway, I think that's a funny one because the reality is nobody can predict exactly what's going to happen. Even the all those downturns I showed you, every time we have one, like, we're going to put all these measures in place. It will never happen like this again. I don't know. It's going to be something else. It's going to be something totally different that we did not expect. COVID, inflation. Although I would argue inflation, that one should have been no surprise to anyone. You pump that much money out into the system and then cut off oil and gas. That's economics 101. That's inflation 100% every single time. So questions. I'll build on that inflation question because that's how we got to where we are. Now the question is, where do you think we're going? What do we do about where we're going, not knowing what's going to happen? So there was another question, I think, besides yours. Yes.
So this is more like your strategy, firm that you came up with.
Yeah, and see that the guy I told you about that's in California. He's the one that does lots of research, and then we collaborate on what we adjust and change. A lot of firms go to third-party outside managers. Fidelity has a bunch. SEI. Brinker Capital, JP Morgan, and they just say, hey, this is their 60-40 portfolio, we just put it in there. We run our own. And the reason why is because we want to be able to tailor things, and we just think everybody doesn't fit into the same box. So does that answer your question? Yes.
So with on tailoring everything, do you kind of have like a certain demographic that you like to work with, like retired?
That's a good question.
Or like for you, what's your specialty? And like for your firm, do you guys multiple different types of things? Or do you guys mostly focus on one?
Good question. Okay, so years and years ago, when I was kind of organizing, as we grew, we were like, okay, now how do we segment? Because you can't handle everything, right? How do we manage this? So most firms have, and this is not just a financial planner, A clients, B clients, C clients, and it's usually based on how much money do they have with us. Where you said, I don't like that man. Because I have people that started with me like the first year, she said I could say, Bonnie Lau. She's an angel sent from heaven. The first year I was in business, I didn't know a thing. She gave me my first real shot and really kind of got me going. And so I've told my team at work, if Bonnie calls, if she asks for someone to bring her soup, you do it. You do anything she tells you to do. She is like one of the most important people to me. So the reason I bring that up is because I didn't want to segment people based on how much money they give. Now it does have something to do with it. But what we did is what you were saying is we wanted to do it based on their stage of planning. What that means, we have 3 distinct groups, and we have different people on that board, our partners, that are specialized in these different groups. The first group, early growth. You guys are all in early growth. That means managing debt, student debt, maybe a mortgage at some point in the future, getting a family up and started, whatever it might be, first job, first early benefits. How do I organize myself? And that usually means your now bucket is usually everything you're going to do right now. You know, you're just trying to make ends meet. That's pretty normal. Second group is growth stage. And that is, okay, I'm now in my career. I have my house, I have my mortgage, I've got the basics in place. If I just play by certain rules, I can see where I'm going to be. Now I can see my standard of living is going to be at least the same, if not better. Okay, that's the growth stage. That's the vast majority of people. The last one is wealth management. You've got more money than you're ever going to spend. Now what? And that's where I go to the estate planning side, where we say, you know, for example, here's a good one on the estate planning side. So I have one client that is very, very, very low, many millions of dollars. Started very poor, grew up in a house that didn't have a lot of money. He said, hey, nobody's modeled this for me. I don't know what I'm supposed to do. But the one thing I'm more worried about than taxes or anything else is my kids. I don't want to make them lazy and useless. He said, so this was his solution. He said, when I die, everything goes in my trust. Now, for estate planning, for a very simple explanation, your will and your trust are not the same thing. The will is good for one day, then you die. But you say, here are the basic things I want people to have, heirlooms, blah, blah, blah. If you're young, who's the guardian of my children? Very important. The trust is what exists beyond you. So what he said is, when my wife and I die, all the money goes into trust. Gibbs can take it out in one of 4 ways. First one is basic health and maintenance, meaning health insurance and a good place to live, just a basic place. Second one, unlimited education, however, with accountability. And the way he put accountability in, he said, my kids or my grandkids, they have to earn the first year's tuition, books, and housing on their own. Once it's in there, at the end of the semester, if they meet certain criteria, they'll get reimbursed every penny plus any increase on the next. You pay one time. That's it. But you're accountable all the way through, and you can get a PhD if you want. So that was his education side. Then he said, once you're out of school, the trust will match up to $100,000 of your income, W-2 income. Earn 50, get 50. Earn 100, get 100. But you have to work. Can't get it for free. The last one, if they want to go work for a charity for free, provide them kind of a modest salary. You would always have work if you wanted. So that's, now you can create anything you want. That's just the example. I mean, you can be as creative as you want to be. The point being, I don't want to hurt anybody's feelings. Everybody's family is weird. And in your own weird family, you have to figure out what motivates for good and what motivates for bad. And then you have to design around that. So long explanation, but 3 groups. That's how we're organizing it. We have a specialist in each area because you use different tools in each of those groups. I don't have the master, you know, I don't have the control. I don't know everything there is to know in those early stages. That's Scott and Anna. So, yes, another question.
What stage do you like?
How well managed is. I'm the old one. So actually my partner that you saw out there, he's also in that same agreement. We kind of run our practice where he has his clients and I have mine, and then we monitor, we kind of share expenses and do a lot of marketing together, things like that. A lot of like collaboration on ideas. He's who I go to if I can't figure out a solution. So up here first, and then
what would you say your like average portfolio sizes of your clients, and like how soon would you have to be to get a financial manager? Like how old are your clients?
That's a good question. So average, I don't know. We manage, and I don't ever track that because that's one of the elements I think. What does it mean? I mean, if you have a portfolio, I have clients always say, "Oh, you're probably too big for me. I'm too small for you." I don't want anybody to ever say that to me. It's big to them. All the money they have, it's important. So that's kind of my approach to it. But when should you start with a financial planner? I mean, the basics, when you can get some basic things in place, especially once you get your retirement in place, even earlier than that, most guys are pretty good about saying, here, let's put some basic ideas in place of how you're going to manage through paying debt so you can start putting money away. Because that's one of the common questions. Should I pay off my house or should I invest it? That's hard. Should I lease a car? Should I buy a car? Should I pay it off or should I finance it? I mean, those are all the questions I want them to call me and ask. So I don't know if that really answers the question all that effectively, but that's kind of my approach. So, okay, over here.
With your guys' portfolio analysis that you run, obviously every guy out in Sacramento, when you're doing that and you're kind of projecting what you think, obviously might happen, what you think is going to be the best different risk analysis. Do you have people that are doing, this is what we think are going to happen with different bonds, with government bonds, securities, equities, real estate, or is it just one guy that basically kind of takes a snapshot really kind of outward of the market? So obviously, the market's going to be different for real estate and normal.
Yeah.
All same trades. But when you're doing that, do you guys have people that are looking at each different individual kind of subsection of that and then making up these reports and kind of saying, hey, this is what we're going to do? And then if so, how often do you change that? Because you come back, and say, over the last 2 years, this is kind of what's happened. This is where we're going to go and maybe switch up and maybe pull some down from this equity and add it in real estate or, sell some real estate, add it in this. Is that kind of like?
Yeah, and that's really at the core of the technical side. So when we look at like, how do we design the portfolios and how do we adjust and change them? That's the core of the problem. And it's challenging because I always tease my engineers. My engineers will always say, well, you do that? And I said, well, you probably can. But the problem is you've got to be on top of it and you've got to have the time. And I'll say the biggest problem engineers have, A plus B always equals C. Not in my world, A plus B and it goes the wrong way. And it's going to make them nuts. So the answer to that is how do we assess risk and direction? There's two fundamental areas. There's a guy named Harry Markowitz back in the 70s that designed what's called modern portfolio theory. Anybody that's in a finance class, you're going to learn all about it. Two sides to it. Fundamental analysis, trend analysis. Two different worlds. They look at the whole thing completely opposite each other or different from each other. Fundamental analysis, statistics, earnings reports, inflation, government spending, money supply. All these statistics are supposed to give us a sense of where is it heading from where we are currently. So we look at that over there, put it aside. Trend analysis, strength. In other words, there are ones that are down for some unusual reason and there's still potential for the upside. What direction? So is it strength driven? When those two point in the same direction, gives us a pretty good feel. Now, that's a very generalized answer. For example, in bonds, right now bonds are tough because interest rates are on the rise. Now, the problem with bonds, bond is $1,000 loan. If I lend money out right now and I go long, like say, oh, so here's someone that's got a mortgage, 30 years, 3%, 8 or 9 months ago. Am I going to regret lending them that money? Yeah, rates are going to go up and I'm stuck at 3. That's terrible. I don't want that. So you want bonds that are very, very short, meaning it's at 3%, but only for a year. Rates go up, I'm going to roll up to the new rate. So when interest rates are on the rise, bonds you want very, very short. Now, if we get to the point where it's at 8 or 9%, go long. I want to lock those babies in for 30 years. And when rates drop down to 5 or 4, and I'm at 10, whew, that's awesome. And that also changes the price of the bond. Like if I have a 30-year bond at 3%, and rates go up, who wants my 3% bond? Nobody. I'll have to sell it instead of getting $1,000, which I put into it. I might only get $900 or less. So those are the things that go into the pricing of the models and how we try to kind of work around it. Knowing that we're shooting at a moving target. Things are shifting all the time. It's hard. And so that's one of the challenges in what we're doing, is trying to make sure that we're repositioning in the right timeframes. Because we always joke that, you know, buying and selling, it might be a little bit like a teenager with a zip. The more you mess with it, the worse it gets. You know, there's a time to do it, and that's probably not a great example, but there's a time to do it and time not to. Time to just leave things alone and let them, you know, swing through the markets. There are times when you don't do that. So, okay, I want to answer that. Yes.
So I think that financial planning can be kind of a hard thing to get into, because like when you're first starting out, you have to go find all your clients, and it can be kind of difficult because, you know, like you said, you have to be good at what you do, because people want to see your team, and you're checking out to be the best. So what was it like for you starting? And I guess
yeah, and that's what I did. Don't do that. The reason why I say that, a couple of reasons. One is I moved back to this valley. I told you my dad, he was, you know, a big builder, and people knew him. I mean, so he didn't refer anybody to me. I was on my own, but he had a good name, and people knew who I was, and that was huge. A good name was big, but it was one by one by one by one. My average in industry, the average age of a financial planner is between 55 and 57. That's old, in case you didn't know. What that means is there's a lot of people that are getting out sometime soon. I would go and I would try to work my way into a firm that has an existing client base and figure out a buy. How is this guy going to exit out into the sunset? How do you buy into that book and not have to go and pick up everything one by one? Now, remember, there's also captive companies. I won't name names, but basically they own you. You're adding to their client base, not your own. And so that's challenging, because if you're doing it on your own, it's harder than if they provide for you. So there's two ways you can do that. You might say, you know what, I'll go work for a firm that's going to provide me a client base, pay me a good salary. I don't have as much pressure, not as much up and down. That's okay. Nothing wrong with that. Oh, anyway. Yes.
Taking a step back, what would you say was the biggest and catapulted you in your career?
Bonnie Lauer. Now there's 2 or 3 people, because all along the way in that first 3 years, you can be completely prepared and gifted and talented, and the wrong things can happen to you because you just failure. So some of it is just being prepared for the, you know, and outworking everybody. You know, when I went down with those 20 people, they had all these stats that they tracked on all of us to try to help us and measure us. And I remember thinking, okay, there's only 4 of those that matter, because I control them. I don't control everything else. If I don't beat everybody else in the room in those 4 categories, I'm out of business. That's the way I approached it. So, you know, there's nothing that overcomes hard work. Nothing. And the reality is, I kind of think, you know, people see it and think, oh, John, you could do that. Anybody can do that. The reality is, a lot of what I did in the early stages, other people wouldn't do. And so you kind of have to look for creativity. You know, how do I approach it in a unique way? But also just the gritty hard work. I changed my own life, you'd say. You know. So, have a question?
Yeah, I was just going to say, kind of depends on the age of your clients, how frequently do you talk to them, and how much they come in.
It goes back to the stages that we talked about.
Yeah.
The wealth management clients, they like a lot of attention, but they don't want to sit down all the time. So there are 2 approaches. There's the systematic meetings and the non-systemic, meaning like we want to sit down at least twice a year, and usually it's year end and tax time are kind of points where people want to say, okay, where are we? And then throughout the year, there's 2 other times for sure. And usually there's 8 to 10 contacts, if not more. But the other 2 times are just me calling saying, hey, I just walked through your account. Just want to let you know this is what I'm thinking. And they just appreciate that they didn't have to call me and say, hey, where am I? So I try to be, you know, somewhat proactive. When the 08 crash happened, I was up in Coeur d'Alene, Idaho at a conference. And I went to the guy and said, I really am sorry, but I can't talk. I can't come to your conference. And I sat in that hotel room and I just called. And I said, call them before they call me. And that alleviated a lot of fear. Because I'll tell you, fear is a big motivator and people do irrational things. And that's why average return, the average investor makes about 4%. Markets make about 10. Why? Behavior. So anyway, that's kind of my approach. Okay, we're done.
No, we can go a couple more minutes.
Okay.
But let me ask a question. So in
Yes.
terms of your average day, how much client facing, how much behind the computer, how much other things you're doing, and how is that compared to the people that are just coming in terms of social fire?
This is a very important, this was like one of the most revolutionary pieces that I got from that strategic coach group that I went to, was time management. Now it sounds simple, but it was, okay, here's the difference. I have 3 kinds of days. I have free days, I have focus days, and I have buffer days. Free days, my team knows that if I call in on a free day, they can hang up on me. I'm not supposed to be thinking about anything but my own personal stuff. Now they don't do that, but they could. I've told them they can. So those are free days. And that's, you know, in like the Stephen Covey world, it's sharpening the saw. You've got to break away and clear your mind and be ready to be focused. The focus days is when I do my unique ability. What is it I do best? I should either be in front of a client or doing analysis. Don't do payroll, don't do all this other stuff. So I try to hire out everything that is not my unique ability. So the third thing is the buffer days. Those are the days where I have stuff I have to continue education, staff meetings, team meetings, planning meetings. That's my buffer day. So I usually have 1 buffer day a week, 2 free days, Saturday, Sunday, sometimes more. And then 4 focus days. And focus days, I like to have 4 to 5 appointments. I always tell my team, you want to start with 11 o'clock and 1:30, hour and a half on each side. Lunch is next, then the earlier times. I can fill the middle of my day first. That's when I do the best. So that's kind of my own thing. But if I can clear out everything but what I do really well and get that out of my way on 4 days, it is amazing how efficient I can be. It's like when people go on vacation, and you have all your work that day or 2 before, and you just think, oh my gosh, it's so much to do. It's amazing how much you can do in that short period of time if you're totally focused. And that's the idea behind it. So.
Okay. What you wish you would have known from school? Anything that comes to mind in terms of the financial planning side?
Behavioral. I did a lot in corporate finance, a lot of the analytical stuff, and I came out, like I said, thinking logic is going to rule the day. Now, financial behavior, psychology, huge part of what I do.
Perfect. I can put your email up if anybody has questions and
Sure.
they can reach out, I assume.
Yeah.
Right, that's good.
Yeah.
Okay. Thanks, John.
Thank you.
Okay, you got to write up. Listen, this was fantastic because this is what he's doing with his client. He's talking to them, he's walking them through things. What does an appointment look like with him? Like that. Right? If you're comfortable doing that, if that's what gets you going, helping people out in a variety of situations in terms of their finances, boiling it down into, you know, very complex things. You look at that portfolio. That's not a simple portfolio. 5,000 securities across different asset classes across different countries. Right? How do we boil that down and explain that to somebody that's sitting in front of you that has no idea? Am I okay? Right? Answering that question. I mean, you can see how that is valuable and how he can, how that's enjoyable as well as a career. So thanks, John, again. Yeah. And like I said, any questions, you can reach out to me.